Hello, everyone, and welcome back to the next session of the CMA Part 2 revision session. In here, we'll be doing the next section. Right now, we'll be doing section C, which is a decision analysis of the CMA Part 2, in which we'll be covering the CVP analysis, marginal analysis, and also the pricing strategy. So those who are watching this for the first time, let me just tell you, is we would be doing the overview content review of this particular section, and then we'll be going towards the MCQ solving. So first we'll go an overview, we'll be having problems. So I will be talking about the formulas which are to be used. What is the reason, what is the rationale behind those formulas we'll be talking about. And then after completing those sections, we'll go towards the MCQ sessions and solve few questions and see how examining questions come. So if you are going to give your CMA examination soon, then this is going to be highly helpful for you. Make sure that you like this video, subscribe to our channel, and also share this video with CMA students who are going to give their examination anytime soon. Moreover, if suppose you are just a person who wants to learn about the CVP analysis or doing any other qualification, wants to know about CVP analysis, pricing strategy, or marginal analysis, then you're good to go. Go ahead, watch this complete session. You will get a lot of clarity. So let me just get started real quick. Let me just share my screen, and I have the CVP analysis in front of me. This is from the Gleim material, one of the best materials. I passed it from the Gleim materials, and I would always recommend a student who is doing the CMA or the CPA to go ahead with the Gleim material. It has a very good question bank. You can go purchase it directly from the Gleim website itself and get the access from it. So if you have any queries related to that, you can reach out to me and ask also. But understand this: if suppose you are using any other material, whether it is Wiley, Hawk, or something like that, if you want to sync in with these sessions, just follow it as per the sections. So this is section C, decision analysis. So let's get started with it. Where's my writing pad is ready in here, and I hope that you guys are powered up to learn from this session. I'm going to give your examination anytime soon, and this will be highly beneficial for you. So starting up with CVP analysis, the cost, volume, profit analysis. So we'll go one by one. If you just see in here, why do we do that is nothing but just to understand that when are we breaking even. Now, what do you mean by breaking even? Breaking even is the time in which you recover your variable and your fixed cost. You recover your variable and your fixed cost with the amount of sales which you do. So at that point, you do not have any profit, you do not have any loss. You've just recovered the cost which you had already invested behind that process. So that's your break-even point. You have two things in here. You have break-even point in units, and you have break-even point in sales. So break-even point in units is nothing but how many units you have to sell so that you recover the amount which you have invested, or you have to recover the amount which you have put in your variable and your fixed cost. The second thing is how much dollars of revenue is required for you to recover the amount which is invested. So that's nothing but your break-even point in units multiplied by the sales units, means dollar sales. Okay, if you just see in here, here's the point at which, now anyhow, this is a revision session. I'm not going to go in detail of that. See, the assumptions in here for the CEP analysis is that the variable cost and the fixed cost are constant. If you just see in here, see, variable cost changes proportionally with the volume, but the variable cost do not change. That's what is their assumption. And fixed cost remains the same over the relevant range. That's what they are saying. I hope you guys are getting huge clarity and able to hear me loud and clear. Make sure that you watch this session till the end. It is going to be a long session, no doubt in that. I am going to take breaks in between and teach you this. You also can take breaks in between. Just pause this video, take a break, come back again. You can go ahead with that. So now, coming up towards contribution margin. Now, in the previous session, if you would have watched, I had made the income statement. I had made the income statement, which was sales minus variable cost gives us what? Contribution. And then minus that contribution, you will get what? Your, sorry, you will minus your fixed cost, you will get your operating income, or you can say your earnings before interest and tax. After that, you minus tax, then you get earnings after you minus your interest, you get earnings before tax, then you minus your tax, you get earnings after tax. You guys need to remember that for sure, because that's going to be tested a lot. That's the income statement format. So what is the contribution margin? What is the unit contribution margin? If you just see in here, sales less variable cost gives your contribution margin, less fixed expenses gives your operating income. That's what it is. Now, what is the contribution margin ratio? If you remember in the previous session, what did we do? Contribution divided by sales into 100. That's nothing but your contribution margin ratio. Is that what? Right? Contribution as a percentage of sales, as this ratio can be calculated using the per unit data. Okay. Now, moving forward, what is the unit contribution margin? As I just said your unit contribution is nothing but your sales minus variable cost. It is per unit, you get that unit contribution. Now, what is your unit contribution margin? Is nothing but your unit contribution divided by the sales amount. You'll get your unit contribution margin ratio. So if you just see in here, 28 is here, your sales value is 40, your variable expenses is 12, and then your unit contribution is 28. Now, what is your total contribution? Simple, just multiply it with the number of sales. Anyhow, see, these examples which are there in front of you, really easy examples. Okay, really easy examples. It's just for your explanation purpose. Just for explanation purpose. But when you go to your examination, when you go for practicing MCQs, you are not going to get this straightforward questions. There are chances that they will trick you in, some reverse calculation, or they'll trick you with some, tricky terms which you're not aware of. And you can be aware of is by only practicing it again and again. Okay, so this is what it is all. Let's move forward now. Now, break-even point for a single product. Here, what did we calculate is nothing but unit contribution margin. That's what we calculated. Now, with that unit contribution margin, we are moving forward towards how much is my break-even point. Now, break-even point in units, what we have to do, we need to take our fixed cost and divide it by unit contribution margin. The rationale behind it is that when you're taking unit contribution margin, it has already covered variable cost. Already the variable cost has been covered, and then you have to cover your fixed cost. So what you're doing, fixed cost divided by unit contribution margin. So you get your break even point in units. The same way, if suppose I get this answer, fixed cost divided by unit contribution margin, I get so and so number of units. If I just multiply it with the dollar amount, I'll get this answer, break even point in dollars, or break even point in dollars. You can see fixed cost divided by unit contribution contribution margin ratio. Now, contribution margin ratio, how do you calculate? Contribution divided by sales into 100. I hope you guys are able to follow it up with me. I have to be a bit fast. That's why I'm not putting it down in this one note. What is contribution margin ratio? Contribution margin ratio is nothing but your contribution divided by sales into 100. Okay, let's move forward now. Now, if you see in here, see break-even point in units, your unit contribution margin, you found out it is 0.4. And you can see here that 25,000, 10,000 divided by 0.4 is $25,000. Now, here, what did you do is nothing but you found out that, see, your contribution 0.4 divided by 0.6 is 0.666667. And you just divided it by the fixed cost, you got an amount in dollars. That's the amount in dollars which you have. Suppose we have this 25,000 units, right? Can we just directly multiply this with 0.60? What will we get? We'll get 15,000 only. So this is nothing but a cross verification which you guys can do. If not this, you can do in that way also. Now, what's margin of safety? Your margin of safety is nothing but you had planned your sales. Okay. Suppose you planned your sales that I need to sell 10,000 units, but your break-even sales is somewhere around 9,000 units. You planned to sell 10,000. Your break-even sales is 9,000. The difference between the two is nothing but your margin of safety. Margin of safety is like, maybe suppose you may not be able to achieve those number of sales. You may not be able to break even at that particular point. So keep a safety of 1,000 units. Now you can keep it as per your own planning. Margin of safety is nothing but ratio margin of safety divided by the planned sales. Moving forward, you'll have this margin of safety on and on. You would be getting some questions here and there about it. Make sure that you have some clarity and understanding about margin of safety, that whatever is the excess of the break-even sales towards your planned sales more than break-even sales is your margin of safety. I hope you guys are following up with me and properly understanding what I'm telling. That's one small section CP analysis done. Not CP analysis done, one just single unit and stuff is done. Then we are going to do target income calculations. After that, we are going to do multi-product contribution margin. So that's coming up. Now, see in here, what did we do for the break-even analysis? Fixed cost divided by unit contribution margin. Now, if suppose we need to have a target profit, what do we do? In that fixed cost, see, we were covering fixed cost, dividing it by unit contribution margin. What we need to do? We need to have the fixed cost. You add it with your target profit, which you want. The target profit, which you want, so that you want to cover up that particular profit also. And then divided by what? Your unit contribution margin. Suppose you want a target profit after tax. After tax is deducted. What do you need to do? Is nothing but your target profit minus the tax, or minus the tax divided by that amount. You will have the value of on which you can deduct the tax. So what it would be like is this. See, 1 minus tax rate divided by 1 minus tax rate. So minus the tax is nothing but you wanted a profit of 50,000, but that needs to be after tax of 30%. So what it would be, let me just do it. You wanted a target profit of 50,000, but that should be after deduction of a 30% of tax. After deduction of 30% of tax, how will you do it? So what you'll do is nothing but 50,000 divided by 1 minus tax rate divided by 0.70. What will you get? Just take another calculator, which I hope you guys are having a calculator. What you need to do, 50,000 divided by 0.7, 71,428. So that will be your target profit. What it is? 71,428. Now, just for your cross verification, what you can do, 71,428 minus 30%. If you do, what do you get as answer? 50,000. So you've got your target profit. Simple, right? Just divided by the balance percentage, you will get the 100% of it. Okay. Now moving forward, see, anyhow, we are going to do MCQ sessions from the GLIME test bank also. So here I'm not doing those problems because they are simple general problems. We'll be doing the main problems which are going to come in. Now, other target income situation, your operating income is nothing but is equals to your sales minus variable cost minus fixed cost. What is happening here? Operating income formula can be used at the following situation. See, it is just you have your operating income, sales, variable cost, and fixed cost. Some or the other thing is missing. What you can do is nothing but seriously simplify it and get the answer. Okay, so let's move forward towards one main topic, which is multi-product calculations for your break-even analysis. And one of a tricky question which can come in the examination, well, not tricky actually, it can take some of your time. Now what you need to do is nothing but you need to find out your weighted average contribution margin. What you need to find out? Your weighted average contribution margin. Your weighted average contribution margin, to find out, you need to find out that which product is having how much number of sales. For that, we'll do this particular example, which is there in front of us. We have product V, we have product W. The sales price of this is this, the sales price of this is that, and then what you need to do, take out the contribution margin of the two. Now, when you have the contribution margin of the two, you see this is 6,000 number of units, this is 18,000 units to be sold. So what you can do is nothing but weigh them. That how much is the total sales? It will be 24,000. Okay, 24,000 will be the sales. Now, when 24,000 is the sales, what's this disturbance? Okay, when 24,000 is the sales, how much is 6,000 for that? How much is 6,000? How much is this 18,000? So what you can do, 6,000 divided by 24,000. How much is that? 25%. 18,000 divided by 24,000. How much is that? 75%. So what you can do is nothing but see how much we've got. 25%, 75%. What we can do, what is the contribution margin here? 3. What is the contribution margin here? 4. So we can take 25% of 3 and we can take 75% of 4. We've got our unit contribution margin, that is weighted averaged. Now, when we have got that, what we can do is nothing but just take our fixed cost and divide it by that. So just see in here, 25% of 3, how much is that? And 75% of 4, here it has given already 3.75. We just add the 2, we get 3.75, and that 3.75 will be divided by the fixed cost to get the answer. So I guess we are almost done with this particular CVP analysis. You guys can go ahead, practice some questions out of it. Let us just move on towards marginal analysis. So changing a chapter, we take a short break. You guys can also take a short break for it. Try taking breaks and completing the session. Don't leave it in between, because there are chances that you opening up a book and studying, you may get distractions. But as this session is going on, at least with me, you will be going on with this and completing it at a faster pace because exams are approaching soon. Okay, so now it is the marginal analysis. It is part of the decision analysis. What all are the CP analysis, marginal analysis, and pricing analysis? I hope that you guys are continuing only with me, but I just took a break and I came back. So the first topic in here is short-run profit maximization. In the short-run profit maximization, we need to take marginal revenue and marginal cost. Now, to get the marginal revenue and marginal cost, we need to go through a particular calculation. Now, what's that calculation? First of all, understand that what's your marginal revenue. Now, how do you calculate your marginal revenue? It's nothing but as the number of units increases, the cost price per unit decreases. Okay, the cost price per unit decreases. So what's the total revenue? We find out the total revenue. What is the additional revenue after each unit? Okay, what is the additional revenue which you are going to receive? Now that additional revenue after every unit sale is happening, that's nothing but your marginal revenue. Marginal, the term marginal means one unit extra or one thing which is extra, one thing which is more than what is expected, marginal. Now, this itself cannot determine it because you've just found out what is marginal revenue. What you need to find out more is your marginal cost. Now, marginal cost, understand this. What happens is, as the number of units increase, the cost of the unit decreases, and after some point, it reaches the plateau, and then again it increases. Again, it increases. So you find out your total cost, then you find out what is the difference of your marginal cost. Understand this. The marginal cost decreases and then it increases. Marginal revenue decreases. Now, the difference between the two is nothing but your profit maximization point. Now, what's that particular point? Understand this here. It is this point where the marginal cost is at the least. When MR, marginal cost, is equals to marginal revenue, MR is equals to MC, which is marginal cost is equals to marginal revenue. That is the point where you have maximum profitability. That's the time when you maximize your profit. What's that point? Your marginal cost is equals to your marginal revenue. That's the point where you have maximum profit. If you just see in here 2250, that's the point at which it is at the nearest. Okay, so moving forward, you can just understand that short-term cost relationships. What happens with this? See, the marginal cost is decreasing and then it is increasing, whereas the average fixed cost or other stuff, it goes on decreasing as the number of units increase, and the average variable cost, you can see in here that what happens is it is decreasing slightly and then later on it is increasing, whereas with the marginal cost, you see it's decreasing at first and then it is going on increasing. Okay, that's the behavior of these items in here. So let's move forward. It's just an explanation of what that graph is. Decision making applying marginal analysis. Now understand this two terms here: accounting cost and economic cost. What's the accounting cost? Accounting cost are those costs which you can record it, like expenses. These are expenses like wages, labor, whatever are the expenses which you have to incur out of your pocket. That is your accounting cost. You can consider it, you can put it as, you can record it as an expense. But economic cost are those costs which you have foregone. That is your opportunity cost which you have lost. How would you record that? That's a bigger challenge, because that's an imputed cost. That's something which is not known directly, which you cannot calculate in an accurate manner. For example, what is an economic cost? I leave a job and then I go for a startup. Now, when I'm leaving the job, I'm leaving a salary. The salary which I have left, that's an opportunity which has been lost. Now, if suppose I have to be beneficial in that particular startup which I'm going to do, I need to get my profits which I desire, and also I need to cover up what I am losing out. And what I'm losing out is that particular salary. At least I should be able to cover up that salary which I was losing out. That is my opportunity lost, that I should be able to cover up, and also I should get the profits which I'm desiring from this particular business. I hope that you're getting this straightforward into your head. And you can see implicit cost is the accounting cost, explicit cost is the accounting cost, implicit cost is nothing but your economic cost. Okay, explicit versus implicit, I've just said that to you. You can see in here, inventory, display cases, rent, utility, these are explicit cost, whereas salary foregone, income foregone. Suppose money is sitting in your bank only, you are getting nothing, just for a savings interest. But if suppose you invested in the market, you're getting more. Suppose if you don't invest in the market and keep it in your hand only, what you're doing is nothing but you're foregoing an opportunity, you're losing an opportunity. You're not putting it in the market. Okay. Now, moving forward, economic profit versus accounting profit, it's one and the same. You guys can go through it. Then relevant versus irrelevant factors. Those costs which are already being done, those costs which are already committed, that these are the costs which are going to happen. Those are the things which are not to be taken into consideration most of the times. And those costs which are going to happen, like incremental cost, these are the costs which you need to take into consideration while calculating. Now, moving forward, you have this avoidable cost, unavoidable cost. What you need to do with these avoidable and unavoidable costs? See, unavoidable costs are irrelevant. Why? Because they are going to be there. But avoidable cost, things which you can forego, you need to make sure you have a concern over it. Now, moving forward, incremental is nothing but your marginal and your differential cost, which we just did it earlier, a few minutes back only. What was it? The extra cost after every unit, or the extra revenue which is going to come after every unit. You take that balance, that's nothing but your marginal revenue, if you guys are getting it. Marginal, differential, or incremental analysis, if you can see in here. So if you see here, what all are the relevant costs? If suppose this is actually a person who is going to sell his vehicle which is 20-year-old. What all will be relevant? Repairs, overhauls, loan, insurance. This will be license plates. It's something which is already done. Trade in value is something which you're going to get if you're going to sell it. So these are the cost relevant, and those are the cost irrelevant, like license plate, and also the cost at which you bought at, irrelevant. Okay, quantitative analysis. See, more of marginal analysis is used for optimum utilization of your resources which you are already having. Like, what are the constraints in measuring of activity, optimum strategy? Having an optimum strategy is nothing but making sure that you have your resources utilized to the fullest. Having your resources utilized to the maximum extent. That's what it is. Going forward, quantitative factors, you guys can go through it. The Robinson-Pacman Act, which is talking about the price discrimination, that will come under pricing strategy in this next unit also, which you guys need to follow it up, in which you cannot kill a competition. That's what they are telling, just by reducing your prices. Okay. Now, decision-making, special orders. Now, decision-making, when you're talking about these special orders and these topics which are going to come up by, is what you can say, if you are doing a particular work. Like suppose I am doing a manufacturing of this particular mobile phones. Now, if I'm doing this manufacturing of these particular mobile phones and I'm having excess capacity remaining, matlab I'm having excess capacity remaining, I can do more mobile phone manufacturing also. So what should I do in here? Should I take that order or not? If I'm having excess capacity, I should take it, right? Because I need to operate in my full capacity. But if suppose I'm not having excess capacity, what should I do now? Should I accept that project or not? That's a concern which you have to do in this decision making of these special orders. Special orders, one time, two time, this order is going to come in. Whether you should take it or not is a concern. When available capacity exists, then fixed cost and other stuff are irrelevant. Just go ahead, take that special order until unless you are covering up your variable cost. Until unless you are covering your variable cost, take it if you are having excess capacity. Now, if you are not having excess capacity, what you need to do, this is something really important. Although fixed costs are committed, given no available capacity, the manufacturer will have to reduce production of existing product lines to fill the special order. Now, this means that the revenue, variable cost, and fixed costs are related to the reduction of production of existing product lines, and that is relevant. So, is this more profitable than your existing work which you are doing? If you're taking a new project, this new project, is it more profitable than the existing project? If the answer is yes, then you can take it up. Now that is related towards the quantitative and financial perspective. Suppose that particular supplier whom you are going on doing that daily work for him is a long-term customer and you are telling them, please stop for some time. There are chances that you may lose out that person who is coming to you regularly. So would you consider that decision or not? That depends on case-to-case basis. You do not have a proper answer for it, but you should consider that what it would be the best for the organization at large and take that up. Okay. Now, moving forward, decision making, make or buy. Now you've got an order, a sales order that, okay, or a purchase order, whatever you call it. You've got an order that we require so and so, like suppose same, this particular mobile phones I want. Now, if I want these mobile phones to be manufactured, okay, I've got an order, I have to do that particular work. What should I do? Should I do it myself or should I outsource it to someone and say that please do it and give it to me? Now it depends. Now what depends is nothing but what is the cost of making it yourself? What is the cost of making it yourself? Then what is the cost if you are giving it to an outsider? You're outsourcing. What is the cost? What you need to do is compare the two costs in here. Now, when we are going to compare these two costs, which is the least, which is the best, choose that one. Whichever is the least, whichever is the best, choose that one. In fact, we'll be getting questions in the MCQ sessions for this make or buy decision, in sourcing versus outsourcing. So if you just see in here, made in-house or just outsource it, depending what you need to do with this make or buy decisions. Like we have a small question in here, but we'll be doing it in the MCQ sessions because this is a straightforward question. Suppose you are doing it yourself, what would be the cost of the component J? This is if you're doing it yourself. And if suppose you are going to get it from outside, what is the cost of it? What should you do? From an outside, the operating income would increase by 10,500. It's understood, right? $8, 9.5. This fixed cost is going to be in here. What should you do? What should you do? See, out of that 1.2 is going to be eliminated if you're going to buy it from outside. What is a better option for you? What's a better option for you? Buy it from outside. Buy it from outside. You'll be able to save a lot of amount. Now, this is a straightforward question. That's why I'm telling you, don't expect these type of questions in the examination. If you get this type of question in the exam, you are going to be lucky for that, but expect, prepare for more. Then make or buy, opportunity cost. Also, we'll be doing it in the MCQ session. Moving forward, we have sell as it is or process it further. Now for this, I have my all-time example, which I keep taking. This also comes in joint and byproducts. which we do it in CMA part 1 also. This is the same in part 2. There's no change in it, though it is coming in marginal analysis, there it is coming in costing. Not much a bigger difference. Here what happens is, suppose I have crude oil. Now with my crude oil, what I can do, I can just extract crude oil, come in the market, sell it in the market. Point number 1, I can extract crude oil, sell it in the market. Now, if suppose I'm just extracting crude oil and I'm selling it in the market, I'm getting a good amount of profit. If suppose I'm extracting that crude oil, I'm processing it, I'm changing it into different products. I'm making petrol, kerosene, I'm making some diesel out of it. And then I'm selling it in the market, I'm getting much more profit, a better profit, though I'm incurring more cost. Now, here is your consideration which you need to make. What should you do? Should you sell it as it is when you've got it, or should you process it further and then sell it? Now, what you need to take into consideration, all the costs related towards the further processing, the revenue which you are going to get after further processing, take that into consideration. Look into which option is best for you. Once you get the best option, go ahead with it. Get the best option and go ahead with it. That's it. See, the common cost, what you do, sell it at split off point. Is it good for you selling it at the split off point? Split off point is at which the joint product is being split into different products. Selling at that point, is it beneficial for you? If yes, sell it at that point. Compare it with processing it further. Processing it further. See, incremental. Processing it further. Are you going to get incremental revenue more than the incremental cost? Go ahead, process it further. Your incremental revenue incoming is more than the outgoing. Process it further. But if suppose your outgoing is more than your incoming, don't do it. Just sell as it is. Okay. Same questions coming in here. MCU questions when we'll be doing that time, you'll have much better clarity for it. Now coming up with keep or buy. Keep or drop. Keep or drop is like, suppose you take an example, Subway has so many store outlets around. Now, is every outlet profitable? No. Is every outlet making loss? No. But there are some outlets which are making losses. What should you do? Drop it just because they are doing losses? See, if I'm a layman, that unit is doing not good, it is making losses, no problem, shut it down, put it off. This is one option, but that is an option of a layman, a person who's not having any knowledge. He can say just that, making a loss, drop it. But if suppose you are a management accountant, you are a management consultant, what you need to do is nothing but look into that, why they are making loss. And if suppose they are making loss and you want to shut that particular unit down or that particular branch down, if I'm shutting it down, will I get extra loss? You need to check that. Because when you're shutting it down, then you have that all cost which you had incurred, that's also going to go off. You'll not be able to recover. Is that a bigger concern? You need to check that as a management consultant. You need to understand whether should I drop this particular segment or not. Now, whether you have to drop that particular segment or not matters a lot. That becomes your disinvestment decision. Should you drop it or not? At times in your exam, now that was a general scenario in your examination. When you're dropping off a segment, right, what you need to take into consideration is what is happening with the fixed cost. Is the fixed cost still remaining? If that fixed cost is still remaining and you have to incur that fixed cost, then dropping off of that product is not a viable idea. If the fixed cost is going to remain the same, even if you are discontinuing the business, you should not discontinue that business. In your examination scenario, that is the place where you need to look into. And if suppose your fixed cost can be discontinued and your fixed cost can be gone off, then dropping off that segment is a better idea. I hope you guys are getting it. Moving forward, incremental approach, keep or buy, you need to look into that fixed cost which I'm talking about. Now, coming up towards the next particular short topic in it, and that is pricing analysis. Really important First, what we'll be doing is nothing but price elasticity of demand and understand that what would be the changes in it. So here, what will happen to the demand? What will happen to the demand if the price is changing? That is price elasticity. If the price is changing, what will happen to the demand? If the price is decreasing, the demand will increase. That is the law of demand. But is it happening or not? If the price is increasing, the demand should decrease. Is it happening or not? How much elastic it is? How much with the change in the price will be a change in the demand? That is what you need to look into consideration, that is that a change or not. So you can see in here, see, as the price decreases, the quantity demanded increases. That's the law of demand. A normal law of demand: price decrease, demand increases, price decreases, demand increases. If the price increases, then the demand decreases. And if suppose the price decreases, then the demand increases. That's a common thing in that. Now, there are some flaws in it. Some suppose exceptions. If suppose those are prestigious goods, or if suppose they are those goods which you are consuming it on a daily basis and that's your daily need, then whether that is changing with the price or not does not matter. The demand will remain the same. The demand will be inelastic to that particular price change. Now, prestige goods and all, you can understand. Now, price elasticity of demand, how do you need to calculate? Percentage change in quantity demanded divided by percentage change in price. Now, how do you do that? Percentage change in quantity demanded divided by percentage change in quantity of percentage change in price is a short formula here, a simple formula which you guys need to remember. Percentage change in quantity demanded divided by percentage change in price. And it is done in this particular formula. If you get a question like that, we will do it. See, that same formula, they have put it down here and got the answer. No rocket science. Now, if suppose you get an answer which is greater than 1, then the price, the demand is actually relatively elastic. If suppose it is equal to 1, then it is unit elastic. If it is less than 1, then it is relatively inelastic. Change is not happening. If suppose the change is up to infinite, then it is perfectly elastic. And if suppose there's no change also, then it is perfectly inelastic. If it is 0, it is perfectly inelastic. Okay. Moving forward towards the pricing objectives, price setting factors we look into here. Now, pricing, what is the objectives of the pricing is nothing but making sure that the cost which is levied on that product, that is getting covered with the profit. That is what you want. If I have this pen, I have made it, the cost of making this pen is $10. I want to sell it at some price in which it is covering the cost and it is also giving me a profit. That is what I want from this particular pen. Like whatever the margin you want, it should be much bigger, and that's how you want to sell it, right? If you're having a business, you want to sell it at a margin. That's what. Now, what are the price setting factors? What will you consider? You will consider how the market is. You will consider what is the cost of this product. You will consider how things happen in the market. What is the stability in the market? Is it new thing in the market, or you already have competitors in the market? What capacity you are having to make this? There are so many factors you will keep into consideration before setting up this particular price of this pen. Now coming up towards the, okay, there's something which you guys need to know, which is price setting by cartels. Now, price setting by cartels, what do you understand by this? Cartels is nothing but group of people selling a similar type of a product. They set up the price of that. Okay, let's sell it at this, like Coca-Cola and Pepsi. What is the price of Coca-Cola and Pepsi? I actually don't know. Less than some dollar or a dollar, suppose a Coca-Cola. Pepsi will also be almost the same only. They don't have huge differences between the two, because if they have those differences, then the customer will choose that product based on the price point. So they have a similar price point only. Now, when they have this similar price point, why do they have it? Is because they are cartel people. They set up the price in such a way that everybody is beneficial, and More about that, they are beneficial for it and they have a good profit coming out of it. And there are many other products like these. With a group of people, they set up the price, or they say that, okay, this is the price which we need to sell, and we all will be profitable in the long run if we do that, and they do it also. Okay, now general pricing approaches, you go towards a market based. How much is the consumer willing to pay? That is a market based pricing. How much is the consumer ready to pay for this particular product? You find out, you survey it in the market, and what you do with that, you go ahead and buy that, or you go ahead and put your price at that particular amount. If suppose you want to know who is your competitor and how much is your competitor selling at, if you want to know who is your competitor and at what price is he selling at, you would like to know that, and you would want to sell it at that particular price. That is competition based pricing. Or suppose you are having a new product. Now when you're having a new product, now you can apply price skimming strategy. A very good example in here is those face mask. When the pandemic came in, when it was at the start, those face masks were sold at a huge amount. They were sold at a huge cost. The price was at huge and people were buying it also. Why? People were highly cautious at that time. But now if you see here, the price is a bit normal only. So price skimming will happen when product is coming in new, the demand is new for that, then the prices will shoot up, and then slowly it will come down. And then pricing by intermediary, you also have this particular penetrating pricing. Now penetrating pricing is nothing but you offer things at free. At start, you want to capitalize the market. If you want to capitalize the market, you offer things for free. And when you offer things for free, you capitalize the market. What happens in there when you capitalize the market? Then slowly you unload your profitable products to them, and they will sell it because you are making a habit for them. Like Reliance Jio, when they came into the market, they offered everything for free. And then slowly they started charging. People got habituated to it. They understood the problem of customers, that they do not have internet at a faster pace, and everybody does not have internet. So they gave that as free. And they gave that at free, they capitalized the market. They had that big market share. Once they had that big market share, then they started selling those products which they have. Now geographical based pricing, these stuff you guys can go through it. Nothing much big in it. Product mix pricing is nothing but you come up with packages like 1+1 free, or you package stuff and sell it at bundle prices. That's possible. Illegal prices or predatory pricing is nothing but, according to the Robinson-Patman Act, you must not set up a pricing strategy which is lowering your you are selling it at a low price just because you want to kill the competition which is there with you. That's an illegal type of pricing. Cost-based pricing is nothing but whatever cost is levied. Like suppose this mic is there. What is the cost of this mic? Maybe the cost is $30. The cost is $30. Add on a margin, sell it off. Cost-based pricing. Don't look at the market or anything. How much is the customer willing to pay? Look into what is the cost. Are we covering up that cost or not? That's what they are looking out for. That's also kind of a markup pricing. So you can see in here 4 common cost based. You can see total cost plus the markup, absorption cost plus the markup, variable cost plus the markup, or you can say total variable cost plus the markup. So it matters. See, you'll understand this more if you've already done part 1. If not, then just read the basic concepts of costing. That will be more than enough. Okay. Then target pricing. Target pricing is that you want to bring down your cost. Okay, you want to set your selling price at that particular amount, because if you sell that selling price at that particular amount, you will be able to sell things. Like if you go to stores, you'll find things for 99 rupees only, $1.99 only, $9.99 only, or 999 rupees only. Why do they do that? These are price points which they want to meet, and once they meet those price points, they'll be able to sell, because customers are trying to the sellers are trying to get into those price points, and the customers are willing to pay at that particular price point. So some psychology things comes in. Now coming in here is the product life cycle. Now product life cycle is coming up next. But value engineering. Now value engineering is setting up a price of a product but only those prices or those costs are to be taken into consideration which is adding value to that particular product. If it is adding value to that particular product, you keep that. If it is not adding value, remove that from the cost so that you can minimize on the cost of that particular product. Now, life cycle costing or pricing, you can see in here, life cycle goes up with introduction, growth, maturity, and decline. Introduction, growth, maturity, and decline. I've made many videos about it, with introduction, growth, maturity, and decline. Make sure that you guys watch it. I'll put those links. Try putting those links in the I section here. Watch that session. Now, what happens in here when you're having at an introductory stage? What you want, sell it at low price. When you are at growth, you would want, competition increases, the prices fall, you'll have more customers at which you can sell. At maturity stage, whatever price you sell, because you're having good demand, customer will buy from you. And at the decline stage, you would want just to sell things off whatever the price is coming in. So you can see in here, low prices, higher prices, and at the highest price in here. And then at the time progresses, you would want to, just finish off whatever is there in your hand. Okay. Then we have come towards another last section. Then we go towards the MCQ sessions. Number one is pure competition, or you can talk about it as the perfect market, where there are homogeneous, there are people who know the market in and out, the products are homogeneous, everybody has the perfect information about the market. Overall, it is also a myth. Perfect competition does not exist. Why perfect competition does not exist is because where will you find customers who know every product in the market? Where are all products where are homogeneous? So it's not there. Okay. Then moving forward, I'm with this anyhow, we do not need to. Where is the next thing? Monopoly. Monopoly is nothing but a single seller. He's the person who makes who is the person who makes the price of the product. He says that this is the price at which I'm going to sell. If you want to buy it, you buy, because he's the single seller doing that. Marginal revenue is equals to 0. When the monopolist has power to set up output and where profits are maximized, that is where MR is equals to MC. This is called price searching. When MR is equals to MC, that is the price, that is the point at which you have maximum prices, maximum profits which you earn. Then the next is monopolistic competition. Now, monopolistic competition, to maximize profits in the short run or long run, a firm in monopolistic competition produces at the level of which marginal revenue is equals to your marginal cost. That's the places where they get maximum profits. But understand this, it's just a slight different towards the monopoly. The products can be differentiated on the basis of the price, quality, brands, and style. Thus, advertising may be crucial. So it's like, kind of a differential product, but almost same market. So it matters on how you market your product. Then oligopoly, it is two or more sellers, more than two sellers only selling up a particular brand, like suppose Pepsi, Coca-Cola. These are all people come under this oligopoly market. At which point does it make highest profit? It is not given in here, but still it's like, few firms come together, try to fix a particular price of a product and sell it in the market. That's what is oligopoly, and those are the types of market. Now we have come towards the end of this session. What we can do right now, not this session is not the end, the content overview is ended. Now we'll be doing MCQ sessions, and we'll get started with MCQ sessions right away. I'll be taking a short break. If you also want to take a short break, go back, revise all these things which we have done, revise it, go through it, watch it once again, and then move on towards the MCQ sessions. And when we are doing these MCQ sessions, I would recommend you that try answering it by yourself. If you try answering it by yourself and get some good amount of answers, your confidence will raise. Okay, let's get started now. Then take a break, come back. Okay, so I just got occupied with some other work. I took a long break, and then I'm resuming this particular session. So we are going to do the MCQ sessions of the decision analysis. Let's get started with solving those MCQ questions. See, the best way of these MCQ questions, you guys need to understand, is that try it out at yourself first. Try it out by yourself first, and then what you can do is answer and then check whether the answer is right or not, because I'm going to solve it anyhow right away in front of you. But before I solve it, try yourself solving that particular question, so that what's your understanding, you'll have proper clarity over it. Okay, just let me just open up that sheet also, 1 second. So here we have our first question in front of us. I hope that I've properly zoomed this particular question and you're able to see it properly. It is from the Gleim material, one of the best materials. Always suggested, I would always suggest students to do it from this particular material. Okay, so now always when we are doing this MCQ questions, we need to read the requirement first. If the company purchases XT9 from outside supplier, operating income would decrease by, okay, in the question itself he's telling that the operating income would decrease by, so the options are also in that particular format. Now a company currently, now we'll read the question, full question. A company currently manufactures subcomponent XT9, a part of the company's main product ZL10. Management has found an outside supplier that could sell the company 100,000 XT9 subcomponents next year for $45 each. The company's production of XT9 cost per unit are shown below. 17 direct material, 16 direct labor, 4.5 variable manufacturing overhead, and $6 for the fixed manufacturing overhead. So the total cost is 43.5, and the component that this person is going to sell us at $45 each. Okay, but we manufacture it at how much? 43.5. Now if you see here, if the subcomponent is purchased from the outside supplier, all the variable cost would be eliminated, and 70% of fixed production cost, okay, 70% of fixed production cost would be eliminated also. 70% of fixed production cost will also be eliminated. Management has found that the space used for the XT9 subcomponent could be used to produce a new product that would generate $300,000 in net operating income each year. Okay, 300,000. If the company purchases, okay, so he's taking the option of purchasing it directly, what would be the operating income decrease by? Now, to calculate operating income, they did not give us sales. Anywhere sales is there? No, sales is not there. So we cannot just get the operating income. So what we can do is nothing but compare the cost of the two. Now, if we are comparing the cost of the two, let me just put it down here, that what can be the cost. See, 100,000 into 45 each. Okay, 100,000 into 45 each, that would be the cost of buying it. Okay, in fact, if you just see in here, if we are making this particular product, it is 43.5. So let me turn on this thing and write it down here. So what is it telling? If we are buying it, it will be 100,000 multiplied by 45 if we are buying it. Now, if we are buying it, still there will be some fixed cost which will be levied. And how much is that fixed cost? It is 70% of this. So 70% of fixed cost is 6 here is the fixed cost. If I am doing 70% of 6.7 into 6 is equals to 4.2. 4.2. Sorry, 4.2 is 70%. 70% will be eliminated. So 0.3 we need to take. 6 multiple 6 multiplied by 0.3. So it is 1.8. 45 plus 1.8, which is nothing but 46.8 multiplied by 100,000. Okay, 100,000 multiplied by 46.8, which is 468,000. This is the cost which will be levied if you purchase it from outside. If you purchase it from outside, and if you are going to do it yourself, okay, if you're going to purchase manufacture it yourself, It is just 43.5 multiplied by 100,000. So 435,000,000. Now this is the difference between the two. If I'm going to purchase it from outside, I'm going to make this much cost. And if I'm doing it by myself, this much is my cost. But about that, what did he say? 300,000. 300,000 is the profit you would generate if you are buying from outside. So what I'll do is nothing but this, I'll minus 300,000. What it would be? 43,800,000. Now, what is the difference between the two? If I'm, manufacturing it myself, that would be the cost. If I'm manufacturing it from outside, this much is the cost. So 50,000, 80,000, the difference is 30,000. And 30,000 is a decrease in the operating income. Let me just see in here. What is the cost? What is there an answer 30,000? Yes, there is an answer 30,000. Yep. Yes, it is. It is also calculating almost in the same manner. I hope that this is highly effective to you. You can see what explanation he has given. He has given in a different format, but we have done it in a different format. Still, we've got the same answer. You can pause it and see that if you want to. Moving forward now. Let me just clear this particular stuff. Yeah. The input and cost information for a firm is presented below. The marginal cost of the second unit of output is, so the marginal cost of the, okay, let me just do here. Let me just make another column as marginal cost. Okay, here 100 to 0 to 100, 100 is 0 only here. Then you see here, what is the difference between the two? 100 and 250. What is the difference? 150. Then 250 and 360, what is the difference? 110. 360 and 90, what is the difference? Sorry, 360 and 450, the difference is 90. What am I doing? Okay. So here, what is the question? The marginal cost of the second unit. So second unit, what is the marginal cost? 110. Is that an answer? Okay, 1 second. Yep, 110 is the right answer of the marginal cost. I hope that you guys remember we just did it in the earlier the session itself of the marginal analysis. Starting with we did this. Now the total. Okay, let me just move this. The change in total product resulting from the use of 1 unit more of the variable factor is no. So 1 unit more. I said you right. That is marginal product, but here it has given marginal cost also. See, marginal cost can be the answer if he is talking only about the cost. Additional unit cost, if he's telling, then that can be the cost. But here it should be marginal product only as a whole. These 2 points B and D does not make any sense in this particular question. Okay. Now let me just clear this off first. Yeah. In a make versus buy decision, the relevant cost, including variable manufacturing cost, as well as avoidable fixed cost, depreciation cost, factory management cost, general office cost. So here, depreciation cost is a fixed cost, so will come here. Factory management cost, general office cost also will not come in here. What will come here is this option A, which is avoidable fixed cost. These are the costs which can be gone off. So if this can be avoided, then it is a relevant cost. So let me just click it and see if that's the answer. Yes, that is the answer. It's avoidable fixed cost. I hope that you guys are, pausing the question before me solving it, and you are trying it yourself so that you can test your understanding that how you are going to give it in the main examination. Okay, moving forward. What is the opportunity cost of making a component in a factory that with no alternative use? No alternative use. If you have no alternative use, means you're not earning anything else from it. So there's no opportunity which you have lost. Yeah, 0. No opportunity lost. 0 it is. Let's go to the next question. Okay, a big. Should the restaurant accept the supplier's offer? Should the restaurant accept the supplier's offer is the question. Okay, what is the offer the supplier giving? One of the items served at a restaurant is pizza that is prepared and baked in the restaurant's kitchen. Each pizza requires $3 of ingredients, $2 of labor to prepare the ingredients, and $1 to bake the pizza, and $4 of the allocated occupancy cost. So rent it is. The restaurant supplier has offered to sell the restaurant pre-made pizzas ready for making $8 each. Should we accept it? $8 each. Let us just see. यहाँ पे कितना? Okay, let me just switch this on. यहाँ पे कितना है? ये $3 है, ये $2. This is $3. This is $2. This is $1. $4 is the occupancy cost. And what did he say that he's ready with? $8. Okay. $8 is the cost at which you can get it from them. So what happens here is $3, $2, and $1. I don't think so. It will be removed because what did they say? Ready for baking. So you will have to bake it. So this baking cost will still be there, and this occupancy cost again will be there. Let us just read the full question without jumping into conclusion. If the restaurant accepts the supplier's offer, the existing pizza preparation space will be converted into 2 additional dining tables. That will increase profits by $42,000 per year. Okay. By selling drinks, side dishes, and desserts, the restaurant expects to sell 15,000 units pizzas annually with or without the additional dining tables. Should the restaurant accept the supplier's offer? Should the restaurant accept the supplier's offer? Should they do it? Let us just start doing this particular problem. So you are going to sell 15,000 pizzas. So if I'm going to sell this 15,000 pizzas without accepting the offer, what would be the cost which I would be incurring here? 3, 2, 1, and 4. So in short, I'll be incurring a cost of $10. Supposedly that my sale price, okay, my sale price is 12. Okay, let me just take my sale price as 12. How much will I be spending on this 15,000 into 2? My profit will be 30,000. 30,000 will be my profit. Okay, 15,000 into 2. If I'm assuming my sale price to be 12. Now this is what I'm doing just to solve this particular question. Now if suppose I'm accepting their offer, if I'm accepting their offer to buy it at $8. Now if I buy it at $8, I'm still liable to pay $1 for labor and $4 for the occupancy cost. So 8 plus 5, which equals how much? 13. So 13 is my cost till now. Now, though 13 is my cost till now, and if my selling price same is 12, I'm getting an additional 42,000 per year as a revenue, as an increase of profits, not also revenue, increase of profits of 42,000. Okay. Now, what can I do here? I'm getting a loss of 15,000 already because my selling price is 12 and my cost is 13. So $1 per unit is my loss. So 15,000 is already a loss to me. And 42,000, I'm getting an additional revenue. So 42,000 is my additional revenue. 42,000 is my additional revenue minus my loss, which is 15,000. It equals how much? 27,000. So my revenue previously was 30,000. Now it is going to be 27,000. What is the difference between the two? Is nothing but my revenue has decreased by 3,000. Is that no? Because my that's the first option only. So let us just go ahead with it by clicking on the answer. I hope that you guys are able to understand this, because this is how you can get your main questions. See, in the textbook, while we were solving, we were not getting that complex questions, but here we are getting a little bit tricky questions, though it is a bit easy only, but still a bit tricky, where you need to apply a lot of senses and a lot of logics, and you will be able to answer it. So I'm going to take this particular answer and see whether it is right. Yes, it is right, but they did some different calculations. If I have to see, kind of different calculations, but we've got the same answer. You guys can read this particular thing by pausing the session. I'm going towards the next question. Okay, so let me just clear this off. Okay, an organization sales revenue is expected to be 72,600, a 10% increase over last year. Okay, so 10% has already been affected here. For the same period, total fixed cost of 22,000 are expected, and the same year as last year. Okay. If the number of units sold is expected to increase by 1,100, what is the marginal revenue per unit? Marginal revenue is nothing but the additional of this particular year. So it means that last year it was 10% less. It is 10% which has increased. And this year the number of units is 1,100. So what we need to do, 1,100, so we have it. So this is the denominator. 72,600 is already been affected by the 10% increase. So what should we do here? When it is a 10% increase, remember this. Before doing it on the calculator, I'll do it here for you. We need to remove this, or we need to find out what is that 10% increase. We cannot just do 72,600 into 10%. That's wrong, completely wrong. What we need to do, 72,600 multiplied by 10 divided by 110, which equals to how much? That this will give us the 10%. 72,600 into 10 divided by 110. 6,600. What it is? 6,600. So 6,600 divided by 1,100 equals to how much? Equals to how much divided by? I guess it is 6 only. Yeah, it is 6. So let us just see if that's the answer. Yes, it is the answer. Now moving towards the next question. Now when we move to the next question, let me just clear this off, annotate and clear all this. Fine. Okay, we have a good amount of question here. Assume that Leland Manufacturing does not wish to commit to a rental agreement, but could use idle capacity to manufacture another product that would contribute $52,000 per month. If Leland elects to manufacture KJ37 in order to maintain quality control, Leland's opportunity cost is. What is the opportunity cost? So we need to read the complete question. See, understand this, guys. I'm not looking into the options at start. I'm looking into the requirement, then going towards the content of the question, trying to figure out an answer then and there itself. And at the end, I'm coming towards the option. Don't jump towards the options at first. There are some questions, maybe you will have to jump towards the options at first, but most of the times, don't jump towards the options. Try reading the question, understanding that if there is any changes or something to be done in here. Now, Leland manufactures 10 units of part KJ37 each month of the production of radar equipment. The unit cost of manufacturing 1 unit of KJ37 is presented below. Materials $1,000, material handling $200, direct labor $8,000, and manufacturing overhead is $12,000. Total manufacturing cost is $21,200. So that's for 1 unit, because it gave right 1 unit. Now, materials handling represents the direct variable cost of a receiving department that are applied to direct materials and purchased components on the basis of their cost. This is a separate charge. Okay, this is a separate charge in addition to manufacturing overhead. Leland's annual manufacturing overhead budget is 1/3 variable and 2/3 fixed. Scott Supply, one of the Leland's reliable vendors, has offered to supply part KJ37 at a unit price of $15,000. Okay, here he is offering at 21,200. Here he's telling how much? 15,000. Okay, I don't think so. It's directly 15,000. And then assume that it uses the idle capacity to manufacture another product, which will give him $52,000 as a revenue if he is going to buy it. So let me just understand that what is the cost of buying it from outside? Is it just 15,000 or is it something more? Now here itself in the question it gave, material handling represents the direct variable cost of receiving the department. And this is a separate charge in production addition to the manufacturing overhead. So what can it be? $15,000 plus what is the handling cost? 20% of the material cost. So what it would be? What is 20% of 15,000? 20% of 15,000 is 3,000. So 3,000, I'll add it. This will become my variable cost. Yes or no? This is at the cost I am going to get it. Now, what is the total variable cost of this particular if we are doing it by ourselves? So by ourselves, if we are doing, then 1,000 is the variable, 2,000 is variable, directly 8,000 is variable. Manufacturing overhead, 12,000. Shall we take 12,000? See, annual manufacturing overhead budget is 1/3 variable and 2/3 fixed. So 1/3 means I need to take 12,000 divided by 3, that is 3,000. Sorry, 4,000 divided by 3 is 4,000. So 4,000, 8,000 direct labor, 200 handling cost, and 1,000 is my direct materials. So what is the total here? 4, 8, 12, 12, 13, 13,200. 13,200, and here is how much? 18,000. Okay. 13,200 and 18,000. What is the difference between the two? 13,200 minus 18,000 or 18,000 minus, it is 4,800. 4,800 is the thing which you are going to receive it here, is actually the cost which you are levying, extra which you are paying. So 4,800 is the extra cost which you are paying, but for how many units are you paying it? 10 units you are paying it for. So how much it is? Into 10, 48,000. How much is the benefit which you guys are getting? 52,000. What is the difference between the two? Is your opportunity cost. And is that an answer? Let me just see. Is 4,000 an answer? Yes, that's the opportunity cost. $4,000. They have given a detailed explanation also for it. Okay. If you guys want to see this detailed explanation, you guys can have a look, but if not, just rewind it and come back. That will be more than enough for you. I'm moving forward towards the next question. Okay, another good question here. Ignore income taxes. The cost relevant to the decision to produce or not to produce the new product would be. So this is talking about what is the relevant cost. The company had decided to discontinue a product purchased 4 years ago at a cost of 70,000. 70,000 4 years ago, sunk cost. Machine has a current book value of 30,000. Current book value of 30,000. Okay. Due to technological improved machinery now available in the marketplace, the existing machine has no salvage value. So that 30,000 book value is also gone. The company is reviewing the various aspects involved in the production of a new product. The engineering staff advised that the existing machine can be used to produce the new product. Other cost involved in the production of the new product will be materials 20,000, labor 5,000. This is the relevant cost, 20,000 and 5,000. Is there a doubt here? 20,000 and 5,000. Yep, that's what is relevant. Now, the last question of this particular session and ending of this particular complete revision session of decision analysis. If a firm currently produces 500 units output, incurs total for cost of 10,000, total variable cost of 15,000, the average total cost per unit. Is that even a question? Is that even a question? 25,000 divided by 550. Yep, here is the answer to it. So we have come towards the end of this session of this particular video. I hope that you guys have got a lot of value from this. If yes, then what you need to do is like this video, share this video with those people who are doing the CMA and aspiring to get started with this. Support us by sharing our content, and anything if you need more, let us know in the comment section below. I read all the comments and I reply all comments, so I'm looking out for your comments, or even if you're putting it down in the chat section beside, I will be reading it. The next sessions are coming up soon. I'll see you in the next sessions. We'll be doing all the syllabus, and this is going to be highly helpful for your examination, and I hope that you guys qualify the examination also. So I look forward for you in the next session. Till then, make sure that you have a lot of clarity over these concepts, and then there are many other things. All the best. Thank you guys.